everyone, and thank you for joining the Across Borders webinar series powered by HDFC Bank NRI Banking Services. Across Borders started in 2025 and now in 2026. HDFC Bank's NRI Banking Services has again come up with another topic which is quite imperative for every NRI living abroad. This year's topic, as you all are already aware, is on decoding NRI taxation. We truly appreciate you taking time to be a part of a cross-border series created exclusively for NRI community living abroad. Now, would like to request Head of NRI Banking Services at HDFC Bank, Mr. Ajit Pandit, to begin with the session. Thank you.
Hello everyone. This is Ajit Pandit from HDFC Bank NRI product team. HDFC Bank is one of the leading bank for the NRI services. We have foreign presence across the world. It's at Dubai, Abu Dhabi, Kenya, London, Bahrain, and also Hong Kong and Singapore. I would like to thank everyone for joining this session, which will definitely help you in simplifying some of the most crucial taxation topics essential for NRIs living abroad. This session would be taken by Mr. Kirit Mehta from GP Kapada and Company. Mr. Kirit N. Mehta is a leading chartered accountant from India, having more than 50 years of professional experience. He serves as the senior partner at GP Kapada and Company, having offices in India and have associates at USA, UK, Singapore, East Africa, and UAE. He specialized in the field of domestic and international taxation, Foreign Exchange Management Act, FEMA, that is popularly known, and corporate advisory. He has delivered talks on Indian taxation and FEMA at forums in India and abroad. He is a member of ICN New Delhi, BCS, and CTC Mumbai. Now, I would like to request Kirit sir to please start the session. Thank you.
Yeah. Thank you, Ajit. First, I would like to thank HDFC Bank for giving me this opportunity to connect with the esteemed customers of HDFC Bank spread over different parts of the world. Of course, today's topic is in relation to Indian taxation, and I am very happy to share my insight on Indian taxation with reference to non-resident taxation and try my best to assist non-resident customers to attend their compliance requirements under the under the Income Tax Act in the best possible manner. I know that we always appreciate investment by non-resident Indians in India and supporting the economic development of India. Simultaneously, this is certainly not a one-way traffic. The investments have been appreciating substantially thanks to development of India, and the benefits are reaped by the non-resident Indians. Going forward, my efforts will be to see to it that provisions of income tax is explained in the best possible manner, conveyed it to them, and also it is necessary that the challenges and issues and difficulties in respect of topics that is being part of this today's cross-border presentation will also be attended, and the overall objective is to ensure that you attend to your compliances under the Indian Income Tax Act in the best possible manner. And also simultaneously, I want that all of you or most of you should not have any hassles in attending these compliances every year. So going forward let me now list out the index of the topics that I'm going to take it up today. So as you will see, the first topic is residential status under Income Tax Act, a very important topic which is most complex also, And that's why I have taken it as a first topic. So there are 5 topics in all, and most of these topics or all of these topics are such that it should help the non-resident Indians a better understanding from this webinar. At the same time, they should able to attend most efficiently to their tax compliances every year. Next. Next. So the first topic is residential status under Income Tax Act. So as you will see, the residential status determines the tax liability in India. So under the Indian Income Tax Act, there are 3 categories of residential status under which anyone will fall. So first status is resident in India, and in case of resident in India, your worldwide income is becoming taxable in India. As far as non-residents are concerned, the taxation of tax liability of non-resident shall be only on income earned in India. Income earned outside India is not taxable for them. Secondly, since the non-residents are also getting benefit of or are settled outside India in the country of residence, they are paying taxation. So the Indian government has entered into various double taxation treaty between India and other countries, and thus the tax treaty benefit is also available to non-resident Indians. Further, the third category of residential status is resident but not ordinarily resident. For them, income earned in India is taxable. Further, the tax treaty benefit may be available to them subject to certain compliances and requirement to be fulfilled by them, and then only they may be able to get. However, overall, the tax treaty benefit available to a non-resident is much more than the treaty benefit available to RNOR. Next. Yeah. So now it is most important to understand that the residential status depends on a number of days stay in India in a financial year. And as you have seen in the previous slide, the non-residents are taxable only in respect of income earned in India. In view of that, it is very important that all non-residents who are generally settled outside India should ensure that they retain their status as a non-resident Indian to see to it that they are taxed only in respect of income earned in India. So now, if we want to check a residential status of a non-resident, the provisions are defined as under. First, on the left-hand side, you will see basic requirements to be a non-resident. One, stay in India is less than 182 days. That is one. Second, stay in India is less than 60 days and also less than 365 days in 4 prior years. If you ensure this, then it is possible for you to retain your status as a non-resident. However, looking at only 60 days stay in India being permitted, it is further relaxed by the tax provisions that there are exceptions to conditions 2 above insofar as 60 days condition is concerned. So Indian citizen leaves India for purpose of employment or as a crew member of Indian ship, 60 days extends to 182 days. Similarly, any Indian citizen or PIO on visit to India, if total income other than income from foreign sources is more than rupees 15 lakhs, then 60 days extends to 120 days. Or if it is less than or equal to 15 lakhs, then 60 days extends to 182 days. So basically, this provision facilitates permitting the non-residents to visit India and stay in India up to 182 days, or alternatively up to 120 days, and thus extension of 60 days to this longer period always is useful, helpful, and of course the non-residents are looking at that opportunity to be in India for longer period. So if you comply with this requirements of the provision of number of days stay in India, you shall retain your status as a non-resident. The next is that there is a possibility that if you are not able to remain non-resident by complying with this number of days, it is possible that you may have exceeded the number of days required for non-resident. So for achieving a status of RNOR, an individual who exceeds number of days stay required to be NRI, and if he satisfies any one of the following requirements, that non-resident of India, he is a non-resident of India in 9 out of 10 previous years, or his stay in India in 7 previous years is less than or equal to 729 days. If he satisfies these two conditions, he will become RNOR, and to that extent, he will protect himself to become a non-resident in India, a resident in India. Thirdly, if a citizen of India or PIO on visit to India having total income other than income from foreign sources exceeding rupees 15 lakhs during previous year, and who has been in India for a period of periods amounting in all 220 days or more, but less than 182 days, he also becomes a person who is resident but not ordinarily resident. And the last one, the number 4, is really very typical. It has been introduced about 3 years before, and one need many of the non-residents may not come under this category, but for the sake of completeness, I have put that particular condition to become RNOR. That is, if he is Indian citizen having total income other than income from foreign sources exceeding rupees 15 lakhs during previous year, and who is outside India or who stays outside India for 182 days or more, and also not liable to tax in any other country or territory by reason of his domicile or residence or any other criteria of similar nature. This is a very typical situation, and not many non-residents are covered by this. It is only in relation to those who are moving around in various countries and not becoming resident in any country in the world. And even in India, if they remain as a non-resident or RNR, then the non-resident, then in such circumstances, they are required to hold the status as a RNR under the Indian Income Tax Act, and in certain circumstances of income exceeding rupees 15 lakhs earned by them in India, then their worldwide income will become taxable in India. In order to ensure that whatever these provisions which are explained, but it may be useful to put it in a very simple term as much as possible, and the same is explained in the next slide by means of a table. So in order to ensure that there is a simplified information to determine your own status, this is most important for most of the NRIs, because the moment you become resident, it becomes worldwide, income becomes taxable worldwide in India. And that is where the non-residents are not willing to take any challenge or risk to change their status from non-resident to resident. And hence, the same is simplified in this table. So NRI who is an Indian citizen or person of Indian origin coming on visit to India. Now, these are the normal situations for NRI who are settled outside India, and they are visiting India only for the purpose of visit and no more. Now, in such people who visit India every year or otherwise, their number of days stay in India, if it is less than 120 days, the next column shows total income. If you satisfy these two conditions, then you will become a non-resident in India. And tax implications has already been explained to you that only income in India shall be taxable in India. Now, so this information is extremely important for you to plan that if you are visiting India every year, ensure that your stay in India is less than 120 days, then you will continue to be non-resident in India. Second is that if you wish to exceed 120 days or more, and you will stay less than 182 days, then if your total income is less than rupees 15 lakhs in that year, then again you continue to retain your status as a non-resident, and benefit of taxable for an Indian income in India shall be achieved by you. However, the third possibility is that anyone who stays in India for 182 days or more, but less than 182 days, and also less than 365 days during last 4 years. In such a situation, if your income is more than rupees 15 lakhs, then you will continue to be non-resident, getting the benefit of taxation. The next is that if you are in India for 120 days or more, and less than 182 days, and more than 365 days during last 4 years, and if your income in India is more than rupees 15 lakhs, then it's a circumstances you lose the status of a non-resident and you will become RNOR, which will lead to your income earned in India is taxable in India, plus your income earned outside India from business, control, or profession set up in India shall also be taxable in India. However, the benefit is that all your income outside India in the nature of interest, dividend, capital gain, etc., shall continue to be not taxable in India. Lastly, if your stay in India is more than 182 days, any amount of income your residential status shall be RNR, and the taxability shall be as explained in the prior column. And otherwise, if you become resident, then your worldwide income will become taxable. There are no significant changes under the Income Tax Act 2025 with respect to determination of residential status, which is likely to be effective from after one more year. So, for your information, same provisions are there. Next, tax deducted at source for NRIs. As you are earning your income in India, the provisions of tax deducted at source is applicable. In case of non-residents, whatever income is taxable in India, which is you are earning in India, a payer of income to all non-residents shall at the time of payment deduct at maximum rate as tax and deposit to the central government. The rates of taxation are 39%, 23.92%, or 14.95%, depending on capital gain or short-term or long-term and other income. However, this is the highest TDA, tax is deducted at source. And however, the actual tax payable by a non-resident is lower or in many cases nil. Now, reason being, there is a loss in any transaction and you're receiving money, but no tax is required to be paid. For example, you're selling a property which is at a price lower than your purchase price, then you will have loss and there will not be any taxation on realization of sale proceeds of property. Similarly, you may have the double taxation treaty benefits or lower rate or non-taxable income. For example, some of the non-residents who are earning income below the limit of maximum limit of tax that is payable on your income. That is generally it is 3,50,000 or 4,50,000. In such a case, our actual tax liability is much less. And as you will see, it is possible that 39% maximum rate is being deducted. However, you may not have any tax liability. In such case, the impact is that you, as you know, you are required to file return of income to claim refund, which is generally delayed in getting refund. And then also, if you realize lower amount than actual sale proceeds or income, then your repatriation or your investment is affected. In order to attend to such a situation, the tax department has given a solution, that is, apply to income tax officer for lower or nil tax deduction certificate. There is a procedure prescribed and subject to certain other documents being provided to your tax officer. He will issue a tax certificate specifying that the tax below the 39% or 23.92% or 14.95% is required to be deducted by the payer. Secondly, you are also required to submit TRC and Form 10F to the payer. So with this procedure, it is possible for you to obtain such tax deduction, or alternatively, if you submit TRC and Form 10F to the payer of certain types of income, the tax will be deducted at a lower rate. So payer deducts tax at lower rate of tax prescribed in the certificate, or as is available the benefit of TRC and Form F to the payer, and accordingly reduced amount of tax shall be collected. Next. Now, as you will see, I've just given for information the tax deducted at source for NRIs and what rate. So normal rate is 30%, 20%, or 12.5%. However, if surcharge and cess is included, the rate goes up to a higher amount. Now, what is the type of income? So if you are earning rental income or short-term capital gain of an immobile property or specified mutual funds and other assets, interest on NRO savings account or fixed deposits, the rate of tax shall be 39%. And in case of short-term capital gain, dividend income on shares, and income from units of mutual funds, the rate of tax shall be 23.92%. Further, in case of a long-term capital gain on securities as well as immovable property, the rate of tax shall be 14.95%. This is just for your information. Yeah. Next. Now, the next topic is very useful and very important. As you know that you being a non-resident as an individual, you are non-resident in India, but you are resident in a foreign country. In such circumstances, what happens? If you are earning income in India in the nature of interest, capital gains, and dividend, etc., the taxable in India at 20%. And the same income is also taxable in the country of your residence, say 20%. Though a situation arises that you are paying taxation in India as well as in other country of your residence, taxable in both the countries. Now, what happens is that this double taxation on a subject is not a good position. Having realized this, the Indian government and other governments have entered into various double taxation agreement between the two countries, by which it is possible that the tax is reduced and in certain specified manner, the procedure is prescribed for grant of benefit under double taxation treaty. Now, how that benefit is granted is being explained on this slide. The relief under DTA is granted by way of complete exemption of income. That means many of you may have been earning the income from interest on NRE account as well as FCNR account. Now, in such case, there is no tax at all. And at the same time, there are certain other income where income tax is not charged. For example, India-Belgium Treaty exempts income tax on capital gains in India, and tax is payable only in Belgium. So there are reliefs granted in different manner, complete exemption of income, then low rate of taxes, underlying foreign tax credit, and tax paying credits. So second part, I'll take lower rate of taxes. Here you will see that tax paid in India is 20%. And tax payable in a foreign country is 20%. But sometimes some specific rates are prescribed in respect of, let us say, interest or dividends, whereby low rate of tax is prescribed, which is being followed by the tax department. Third is underlying foreign tax credits. Now, in this case, as you will see, tax is paid in India is 20%. Tax paid in foreign payable in foreign countries 20%. As tax is paid in 20% in India, underlying foreign tax credit in the country of your residence, you shall get credit of 20% against the tax payable in your country of residence. In such a situation, you get a relief of 20% of tax paid in India. Similarly, tax sparing credits are also provided in the double taxation treaty. However, it is important that to avail the benefit of double taxation treaty, it is necessary by way of a compliance that tax residency certificate is required to be provided by the person to the tax authorities, and Form 10F is also required to be provided, and this is provided Form 10F by means of online transfer, as well as these forms are also again provided by means of when you file return of income. So in the next slide now, I'm explaining how these benefits are being given to the non-residents for double taxation tax relief. Now, since I already explained it to you fully the prior slide, I'm just taking it up by way of an example that you earn income by way of a capital gain. And if we see the second item, immobile property, when you sell it, you get short-term capital gain or long-term capital gain. You also earn rental on this from this property. Now, how the benefit of double taxation treaty is given. So, if short-term capital gain, long-term capital gain is 12.5%, then tax credit may be available in country of your residence. Whereas when you have sold the property in India, you pay 12.5%, and 12.5% credit may be available in country of your residence. Second is rental income, which is being taxed in India on a slab rate basis. Credit may be available in the country of residence. There is one very important aspect which I would like to take it up at this stage on capital gain on immobile property. Like in India today, all those who are resident in India pay tax at the rate of 12.5% plus surcharge, coming to 14.94%. However, when as a US tax resident, if you pay, you are required to make payment on capital gain on in India to the IRS in US. Now, in view of a very typical system of tax provision in US, the credit for tax which you have paid at 12.94%, is not necessarily fully available as a credit in your US filings. So maybe it is possible that if you paid 14.94% in India, your credit that you get in US will be not 14.94, but it will be 5% or 7% or 10%, depending on the facts of capital gain computation. So to that extent, US residents are in adverse situation who have to pay a much higher tax because full credit is not available. Now, in this slide, I have considered how the credit is being given. So I'm not going into detail, and I would like to shift to next. But at least this chart shows you information as to how much credit is available, and the same can be understood by you. The next. Now, this topic of common mistakes by NRIs. This particular presentation is extremely relevant for non-resident Indians who are earning income in India. Now, normally, over the years, what has happened is that NRIs who are investing in India and earning income in India are required to file their tax returns and attend to assessment proceedings. And generally, it has happened that the notices are issued on non-resident Indians, not only for assessment proceedings only, but the reason for issue of notices to non-resident Indians is on account of certain information available with the tax department. And hence, it is important for me to share with you common mistakes by NRIs and other compliances requirements of notices received by the NRIs, so that if you do not make these mistakes, in most of the cases, you may not receive notices, and that will help you to get your refunds, etc., quickly and without any hassles. So first common mistake made by the NRIs is that you have NRE account, but you don't have NRO account. In such case, what happens is that IT refund cannot be credited to NRE account. It is credited to NRO account. Hence, your interest credit, the refund credit is delayed. So you avoid this mistake so that you did not follow up further with the tax department. The next is not avail DTA benefits. We find that non-residents are many times not availing double taxation treaty benefits. This is something you should not leave. You must ensure that you claim DTA benefits. The third is disclosure of notional rent in excess of 2 self-occupied properties. This is the provision, you may be aware, but we find that many non-residents holding more than 2 self-occupied properties and are not offering notional rent as to the tax department as income and pay tax on that. Now, the moment the tax department comes to know about it, there is going to be an inquiry and receipt of notice. Similarly, the next is applicability of advance tax. Now, here, what you will do, sometimes we find that tax is deducted. Tax is deducted by the payer. But sometimes when the payment is made to you, at that time, tax is not deducted by the payer. However, it is your income. Now, if it is your income, you are required to file your return and pay the taxes. Now, in such circumstances, what happens is that if you are required to pay advance tax, but many times we find that non-residents make payment at the time of filing return of income. In such cases, you are attracting penal consequences, that is by way of interest. And that is something which is not good for non-resident Indians. Yeah. Next, address and contact information not updated on ITE filing portal and PAN. As you know, the Income Tax Department communicates with you by means of email generally, which is preferred. And if your address and contact information, email ID, as well as your physical address, if it is not updated on ITE filing portal or on your PAN database, then in such situation, it is possible that you may miss out the notices issued to you, communication to you, and there is a potential that tax department may take action against you or send the notices, but you have not replied for, and you may face challenges of making additions in your taxable income. The next is NRI status not updated on IT department. So portal, so in PAN becomes inoperative. It is important for NRI to ensure that his status is updated on IT department. So it is shown as non-resident in India. In such circumstances, your tax liability, etc., will be different as a resident and different as a non-resident. And that can attract a lot of confusion as well as notices from the tax department. The next is selecting incorrect residential status in ITR. Now, here also you face a situation that if you continue to convey that you are a resident in India, your filing of return will also be affected by various information that you have provided for, and it can attract notices, and again you are required to attend to the same. Next, if income is more than 1 crore, then every non-resident is required to submit asset and liability schedule in their tax filings. All assets in India, assets and liability needs to be reported. If you don't do this, then you are likely to have a follow-up and notices from the tax department, and you will have challenges to attend the same. Next is non-filing of return of income as tax has been deducted. We find that many times non-resident feel that if the tax has already been deducted, it is important that for me, taxes have already been paid. Why should I file the return of income? But that is not correct. There are various criteria apart from any tax liability requirement that tax return is required to be filed. If you make any mistakes by not filing the return of income, then you are required to comply and respond to the notices issued by the tax department. The next is all bank accounts held in India are not reported in ITR. You may be holding quite a few bank accounts, but you reported only 1 or 2 accounts in the ITR details. Then it is possible that some financial transactions are missed in your reporting to tax department. Some income also may not have been reported to the in your return of income. In such cases, you shall receive notice from the tax department and may have to attend it. Next is convert savings account to NRI account. Now, non-conversion of bank accounts on becoming non-resident or resident. This is very important. Many people migrate from India to outside India. They don't convert, as well as the other way around, when they come back to India and they don't convert their non-resident account to a resident. This shall attract notices from tax department as the compliances are affected, and you are required to take care of this changeover within the time frame prescribed. Next. Non-reporting of FCNR and NRE income in ITR. Again, this is also very vital. Otherwise, your return is not correctly filed. Similarly, DTA benefit claimed without TRC and Form 10F. You can claim DTA only if you've given TRC and Form 10F. And that's where one is required to ensure that these forms are submitted and your eligibility is fully established. Next is bank transfers in and outside India, resident, non-resident to non-resident and resident. Now we find that there are transfers by non-resident Indians to their resident and also from resident to non-resident. Now these are the transactions which can attract certain provisions of the Income Tax Act, like Section 56, gift, loans and advance is not completed in accordance with the FEMA provision. Such cases do attract substantial tax consequences under the Income Tax Act, as well as possible non-compliance consequences under FEMA. So it is very important for such transfers that is taking place along with your friends or relatives. It is necessary that proper guidance is obtained for compliance under Income Tax Act as well as FEMA. Last, the contribution to PPF is not permitted to non-resident. Once you leave India, your PPF account can be continued, but you cannot deposit any more money after you become non-resident. That's very vital. Second is non-consideration of clubbing provision. This is again in relation to your payments receipt with other parties within India or outside India, and which again attracts penal consequences under Income Tax Act, although and also potential of tax liability on clubbing provisions of the Income Tax Act. Yeah. So now what happens? In view of the mistakes, that is one. Plus, it is very important that the notices are received by the non-residents. Naturally, any non-resident who receives such notices anywhere located, he finds it difficult and challenging to respond to these notices. And it happens that he may not be in a position to attend it that quickly to the tax department. Now, many of the non-residents feel that why such notices are issued on them. The reason being that the notices are issued is to be understood by you. Number one is that there is a substantial digitalization of all financial records of Indian persons or non-residents and residents and everybody, which is made available to the tax department and government agencies and others for the purpose of information and ensuring compliance with reference to Income Tax Act or FEMA or other laws. This means what is happening is that your transaction which you enter into in India is fully available with the tax department. Now, when you file your tax returns, it is possible that the tax filings mismatch. Reason is joint account data, incorrect reporting, FCNR, NRI account, etc., mismatch with annual information statement and tax information statement, which will lead to suspicion with the tax department, and they may issue notices. Naturally, so many notices are being issued, and one of the big complaints of the non-resident is that why so many notices are being received. And in view of mismatch, what is happening is that sometimes we find that even tax department may make a mistake of sending notices, which is otherwise not required. But the main reason is that there are facilities available with given to the taxpayers in order to ensure that mismatch is totally avoided. So in next slide, that information is given. That if you find that whatever your records are there for the year, you can always check with the annual information statement available on the website of tax department. You have your content and information with you, dividend, salary, interest, purchase and sale of securities, etc. All this information is available with the tax department on AIS. You can reconcile it, and if you find any mismatch or any shortcoming, you can communicate with the department which handles AIS and convey them that there is a mismatch give the complete details that why this mismatch is there, and you can get the records reconciled. Once you reconcile, it is likely that the tax department will find that everything is matching, and they may not issue any notices to inquire with you. Now, in any case, yes, if you match it, you are able to comply with the tax department fully. However, it doesn't happen in real sense. So many non-residents receive the notices. Now, how to attend these notices? So, in view of either mismatch or whatever the reason is explained, you may receive a notice for scrutiny assessment. Why it happens? High value transaction, high refund, search and survey action, notice issued to verify the correctness of returned income. Now, once you receive the notice, it is necessary that details must have been provided in that notice, that why the notice is issued and what kind of information and explanation is required. So you can respond to the notice, providing the complete detailed explanation and satisfy the tax officer, and who may verify it and close the matter. Similar notices are received from the tax department is notice under section 148. Here also there is a possibility of mismatch of certain transaction wherein there can be inferiors that income has escaped assessment. Here, this notice also will be received by the NRI, and he has to understand it, explain that there is no escapement of income from assessment, the taxes have been fully paid, then the matter may be closed by the tax officer. Next is summons under section 131. In view of the international management of data sharing between different countries under CRS and FATCA, a lot of information is available with the tax authorities of different countries. Indian tax department also gets this, and they on that basis communicate by a notice to the tax non-resident and ask him to submit the required details, reply personally or by authorized representative, and ensure that the tax department is fully explained and conveyed that whatever the transaction they want to examine and check has been properly done. There are no anything non-compliant with that. Everything has been declared and the taxes have been paid on that. Similarly, there are summons and notices issued under section 133(6) for the reason that there is information of income, high value transaction, etc., when ITR is not filed by the non-resident. In such a case, on the basis of the information available with the tax department, the notice is issued, and subsequently the non-resident is required to file return of income, share the appropriate information, and explain and respond to the notice fully so that the tax officer can close the matter. Next is response for confirmation. Many times it happens that high value of tax refund, claim of certain deduction exemptions, high value transactions. So in such a case, notices are issued to check and get the confirmation. Now, if this is not available, the same can result into notices, and you are required to respond to the notice and attend it. But it is very important for you to understand that consequences of non-compliance. What happens is best judgment assessment is done by AO. If you don't respond to these notices, there can be an assessment of high pitch assessment, and you are required to file appeals, etc. The second is levy of penalty and interest if you don't comply with it. And third is that in a worst situation, there is a prosecution in serious or repeated cases. Because if you don't respond many times, it happens that it's difficult for the tax officer to accept what has already been submitted, and he may take all the 1, 2, and 3 actions to attend to this. Now, with this, I have completed my presentation. However, the bank has shared with me some of the queries which I am required to respond. So now I will take it up, the queries raised with the bank and which has been shared with me. So I will read the first query. I am a USA citizen with OCI card and have been staying in India for the last 4 years, most of the time. So far, I have been filing my tax return in India as NRI. My understanding is that OCI card holders can stay in India as long as they want and enjoy NRI privileges. Is this correct? No, dear friend, this is not correct. NRI who is holding OCI, yes, he can get the privileges as a non-resident in India because of the card. However, it is not correct to say that having been in India for more than number of days prescribed and explained in my presentation today, and if you become resident in India, you are required to file your tax returns and comply with all the provisions, and otherwise you may attract action from the tax department on various grounds. Next is TDS on sale of NRI property in India. It's 12.5% now. Is that 12.5% of sale value? Well, your query is the rate of tax of deduct for TDS is 12.5% when you sell an immobile property in India. That's correct. But this TDS is required to be deducted only on capital gains on sale proceeds and capital gain net amount, and it's not on the sales value. But practically what happens is that many times the purchaser conveys to the seller that it is difficult for me to uh, compute your capital gains. I don't know the facts and background of it. You may have inherited the property, you may have bought it before 50 years. I don't know. How do I compute your capital gain and charge you tax only on the net capital gain and not on gross amount? In view of that, to some extent, yes, it is possible that people may ask for deduction at a 12.5%. However, it is possible, as explained in this presentation, that you can obtain a tax exemption certificate and effectively ensure that lower amount of tax is deducted. Next, how many? Now with that, I would like to, with that, the next query is, how many days can an NRI stay in India in a financial year if his income is in excess of rupees 15 lakhs? If the NRI stays 118 days in financial year, next 3 years, how many days can he stay in India? So this is a very interesting query, and the explanation given in the presentation as to number of days stay and proper guidance, I can say that in the fact that has been stated by you, you will continue to be non-resident, and as long as you are staying in India and for 118 days in a financial year, you will not have any adverse consequences of becoming resident or RNOR. You will continue to be non-resident in India. Next, if I return to India permanently after working abroad, how will my residential status be determined in the year of return and subsequent years? And what is the tax impact if I become RNOR? Anyone who is returning to India, presumably after more than 10 years being a non-resident and working outside India, if he returns to India, His residential status for the year shall be that if he returns to India anytime between 1st April to 31st January, then he will become resident but not ordinary resident. However, if he returns to India from 1st February to 31st March, then in that circumstances, he shall continue to be non-resident in that year. Further, it is important for you to examine your residential status in subsequent year. So normally, anyone who is returning to India after 10 years of stint outside India, he shall continue to be non-resident, I mean RNR, for a period of 2 years, generally. Sometimes it is possible to plan it whereby you can extend it to 3 years also. But this requires examining the facts of the case. Next, if is interest on NRE, NRO, and FCNR deposits taxable in India, and does the taxability change if my residential status changes? So, interest on NRE, NRO, and FCNR deposit, of which NRE and FCNR is not taxable in India if you are resident outside India, so you are a non-resident. And as far as NRO account interest is concerned, yes, it is taxable even if you are a non-resident. However, if you return to India, it is likely that NRE and FCNR accounts, NRE and FCNR deposits interest shall become taxable in India. As far as FCNR is concerned, if you are, so long as you are non-resident, you will not be liable to pay tax. However, if you are RNOR, then from that time onwards, you shall be liable to make payment of taxes on this interest income. So with this, now I've completed some of the queries that has been shared with me, and I again thank the bank as well as the non-resident Indians for having offered me to present my insight on Indian taxation. Thank you.
Thank you, Kirit sir, for this lovely session. I'm sure this session must have benefited to our viewers, NRIs. You have covered all the aspects of most of the aspects of the NRIs. If the NRI is coming back to India and he want to settle in India, how many number of days he should stay outside India to keep his NRI status for that particular financial year. Yes, we are going to release this recording for our viewers session completely for their information. We could attend the common queries in the session. Yes, we have received many queries, which will definitely reply. My request, any banking related queries are there, please write to nri@hdfcbank.com. I'm repeating, any banking related queries or any your services related issues, you can write to nri@hdfcbank. This will definitely help you to resolve your issues. We are ending this session, I would like to sincerely thank you to all of our NRIs who has attended this session, especially Kirit sir with his experience in FEMA and its income tax field. He has given a good insight. I'm sure this will help to all of us. We will come as a HDFC Bank NRI banking with the more such session for our NRI customers. With this, we are concluding our today's session. Thank you for participating.
Thank you everyone for